All right, everyone, I've just started the recording, so you know what that means. It must be time for our Wednesday noon webinar. This is what you do at lunch on Wednesday. You nourish your mind as well as your body. Maybe as you're nibbling on your sandwich, you can hear about year-end tax planning for your business. And you might say, what the heck, year-end? This is just February. Well, I think what you'll hear from Barbara, and she can correct me if I'm wrong, is that you need to think about next year's taxes right now so that you can plan accordingly. I am Diane McKeever. I am the education chair of our SCORE Minnesota chapter. And before I introduce Barbara, I am going to tell you a little bit about SCORE. SCORE is a nationwide nonprofit organization, and we're a partner with the Small Business Administration. SCORE provides, and this is really important, free, never ever is there a fee, confidential business mentoring. Our chapter has nearly 90 volunteers standing by waiting to help you with your small business questions. So apply for a mentor at our website. I'll tell you about that in a second. But our chapter was recently named as a district chapter of the year. SCORE National has, for more than 50 years, assisted over 11 million clients. So what part of your business can we help you with? And the answer is all parts. You're thinking about starting a business, you woke up with an idea this morning and you want to kick it around the water cooler. We're the water cooler, as it were, and we'd be happy to kick it around with you. Or you've actually started one and you realize that you are hitting some roadblocks. We can help you. Or you're in business and you want to grow. We can help you with that. Or lastly, you're selling or closing a business, or conversely, you're buying a business. I have a client who's looking to buy a business, so I'm bringing in a co-mentor who knows more about that than I do, and we're going to help her so that she doesn't pay too much for her business. So we can help you in all aspects of your business. Go to score.org/Minnesota. And there is a huge button there that says request a mentor. You'll click on it, you'll put in some basic information about yourself and your business, and ta-da, suddenly somebody is contacting you. If you're interested in more workshops, because as I said, every Wednesday we do this, virtually every Wednesday. I can't even think of one that we missed. I think Christmas and New Year's, but other than that, we're here all the time. So just click on local workshops and sign up for some more, or do a search for recorded webinars or resources. And lastly, I want to thank our sponsors and community partners. You'll note that a lot of our sponsors are banks. And if you come into any of these banks and you've got a SCORE mentor on your arm, believe me, they are going to listen to you a lot more than if you just walked in with a couple of sheets of paper and, dog-eared receipts of things. They will listen to you a lot more if you walk in with a SCORE mentor. So think about applying for a SCORE mentor at score.org/Minnesota, and thank our community partners. So without further ado, welcome Barbara Weltman, and I can't wait to hear what we should be doing right now to prepare for next year's taxes. Take it away, Barbara.
Well, why don't you advance the slides? We had a little technical difficulties, and so I don't have control of the slides. So I'm an attorney. I have to share this disclaimer that the information I'm providing it's just information, not advice, and you need to bring any of the things that I've mentioned to your own advisors and run it by them to see what's appropriate for your situation. Next. And this is just a little about me. I'm not going to spend any time here because you will get the slides and you can learn more about me when you see the slides. So let's begin. And we're not going to do year end. We're going to really talk about, even though now is the time that everybody's kind of focused on their 2022 returns, it's really a great time to start thinking about your taxes for 2023. This is important because it will help you plan for the year ahead. It'll help you make business decisions that are tax sensitive, and it will also help you make your first estimated tax payment, which is due April 18th, 2023, which is not too far ahead. So again, Not everything I talk about today will be relevant to you. Some will, it all depends on your situation. What I'm going to do is kind of break things down. I'm going to talk about some of the tax rules that relate to your employees with respect to your customers, your equipment, your operations. And again, just to repeat, take it by your own professional. And just one last thing, I'm basically focusing on federal tax rules. I'm not covering anything at the state level. And so there may be some different rules at the state level, additional rules at the state level that you want to think about. So let's begin. Next slide. Okay, one of the big things that we know today is inflation, and employees are suffering, paying for eggs at the supermarket. So as employers, what can you do to attract and retain good employees? And that's always a challenge. It's especially tough now with a very low unemployment rate, with a lot of other things going on. Note that we have a higher Social Security wage base for 2023. So in terms of employment taxes, if you hire higher earners, you're going to be paying more in your employment taxes. Look at the kind of employee benefits that you might be able to offer to, as I said, attract and retain good employees. So health savings accounts combined with a high deductible health plan might be just the thing for you as a small business to provide affordable health coverage. And that's the challenge, right? We're not super large companies that can go into the large insurance market and get smaller premiums. We pay in the small insurance market, and that's kind of pricey. Dependent care assistance. During COVID, this was a very big thing because so many people had their kids at home or had to take care of them while they were working at the same time. There are ways to do this on an affordable basis. In fact, there's ways to do it by having employees pay for this out of their own paycheck on a pre-tax basis. So it doesn't cost you, the employer, anything other than administrative costs. Adoption assistance, not too many small businesses offer it, but it is there. Transportation fringe benefits as employees come back into the workplace. If you're going to pay for, perhaps offer free parking or monthly transit passes, van pooling options. Again, look at ways that you can do this on a pre-tax basis where the employee is actually paying, but it's kind of a win-win. So again, this is something that you have to, that whether you offer this depends on what you think your employees need. If you are offering or continuing to offer the remote work arrangements that became so popular during COVID, then transportation fringe benefits obviously aren't a must. Remote work arrangements definitely is something to consider, whether it's full-time remote or partial remote. Many employees prefer this because of their other obligations, perhaps childcare or work-life balance, not having the time to commute and such. And maybe you can scale down your physical premises. You might not need all the space that you have now. So certainly, that's something to think about. Okay, going on. If you are going to hire new employees, take note that there's a tax credit. And just as a heads up, a tax credit is a dollar for dollar reduction on the taxes you owe versus a tax deduction, which is only worth as much as the tax bracket you're in. So let's say you're in, there is no 25% bracket, but I'm going to just say it. Let's say you're in the 25% bracket. A tax deduction would save you $250, whereas a tax credit would save you, let's say you have $1,000 expense that you can write off. The deduction would only save you $250. The credit would save you $1,000. So tax credits are really valuable. And in recent years, we've gone toward more and more tax credits. As you'll see in this program, where I introduce a number of new tax credits that are brand new for 2023. So this is not a new credit, but something that should definitely not be overlooked, because you get it just because you hire an eligible employee. The key here is that you have to submit this IRS form to your state workforce agency in a timely manner. Even if you hire someone who would be in this targeted group and could entitle you to a credit, if you fail to submit the form, you lose out. So I'm just giving you a heads up. When somebody comes on and you're onboarding somebody and you're having them sign their W-2 form, their W-4 form rather, and their I-9 and other paperwork, just have them complete this form. So you're all set to go. Moving on. Okay, so we had new credits and new things. There are brand new rules with respect to retirement plans for 2023 because Congress passed the Secure Act 2.0 as part of the Consolidated Appropriations Act 2023 in December. So we have an increased credit for businesses that qualify as small employers and start retirement plans. It's called a pension plan, but it doesn't have to be a pension plan. It can be a 401k or any other qualified retirement plan. Take a look at the eligibility and the amount of the credit, because it can be significant, and you get this credit for up to 3 years to cover administrative costs and educating employees. Note that there's a higher, if you already have a plan, you won't have to make distributions for those who are 73 now, who attained age 72 after last year. So higher age for starting distributions. And they didn't change the rule that if participants continue to work, as long as they're not more than 5% owners, they don't have to take their distributions, required minimum distributions, until they actually retire. Retirement plans are meant for retirement, so that you can't just willy-nilly make distributions. You lose your qualified status. But plans are allowed to make hardship distributions, and the new law made it possible for employers to rely on self-certification. So if an employee says they need a hardship distribution, you don't have to get a whole lot of paperwork from them. Just get this certification, and it protects the plan, and it makes it easier for employers. Also easier is that notice requirements. Once somebody opts not to participate, you don't have to give all the paperwork to them, all the notification, other than the annual notification to participate. Okay, let's move on to the next slide. All right, we're in 2023, and there are a whole slew of new rules that are going to take effect in 2024. And it's not too early to start looking at these, because they may impact you directly. One that I like to point out is that there's going to be a new option called a starter 401k. This is for small employers that don't have a plan, and it allows employers to basically set up the arrangements so that employees make contributions effectively to their own Roth IRAs. It doesn't really cost the employer anything to do this other than administratively. And so this is really going to be a very good option for some employers that want to help. You're very small. You can't afford to make contributions, but you really want to help employees save for retirement. And this is going to be one great way to do it. You're also going to be able to allow employees to have emergency savings accounts. So many people don't have the wherewithal to don't have the wherewithal to pay some emergency expense that comes up. So this is going to be a savings option that plans can allow. They can allow emergency withdrawals. There are restrictions in how often you can do it and such. Going to allow for penalty-free withdrawals for domestic abuse victims. And student loan payments are going to be treated as elective deferrals for purposes of employer contributions. So instead of an employee making a contribution that gets matched by the employer, they're going to pay off their student loans, and the employer can make the matching contributions to that. And there are going to be a number of changes with respect to simple IRAs, which are plans that are used by small employers. I know a local deli that has a number of employees, he uses the simple IRA because it just works for his situation. Minimum contributions, he knows pretty much at the beginning of the year what it's going to cost him, and it's really a great option. All right, next slide. All right, just want to mention the employee retention credit, because maybe you're hearing a lot about this. I know I've been hearing a lot on the radio and TV ads saying, don't miss out on your credit. This was something that came about because of COVID to induce employers to keep people on the payroll. The credit actually expired, but if you're eligible for it, you can still claim it. And I have the dates on your slides. Another thing that's new for 2023 is small businesses that engage in research and development may not have the revenue to take a regular tax credit. So the law allows you to offset the employer portion of Social Security taxes. In 2022, it was limited to Social Security taxes up to $250,000, but starting this year, it's going to be an additional offset of $250,000 of the employer share of Medicare taxes. So this is up to $500,000 of FICA can be offset by R&D costs. And that's really a very significant thing, because when you think of R&D costs, you may think, oh, like the companies that engaged in COVID vaccine, research. But the fact of the matter is that a lot of R&D occurs at the small business level, and here's a real good incentive for it. All right, moving on. Determine whether you're going to be an applicable large employer subject to the employer mandate under the Affordable Care Act. In other words, it's based on the prior year payroll. So you have to think about that. If you're not, you may qualify for a tax credit if you do give your employers coverage that you buy through the government marketplace and you pay at least 50% of the premiums. So here's an incentive for small employers to help employees pay for health coverage. There are information returns that have to be filed if you offer certain coverage, certain types of health plans for employees. In other words, if you are a large employer and 50 or more employees and full-time equivalent employees, or if you're a small employer and you offer certain health reimbursement arrangements that's self-funded, so you're paying for, you have to file annual returns. Just check with your tax advisor, make sure that all the returns have been filed. Okay, let's go on. Just mentioning a couple of ways that small employers can help pay for, or help employees pay for their health coverage. I mentioned health savings accounts combined with a high deductible health plan. The employer can set up the plan and make the contributions, or set up the plan and the employee makes the contributions. If the employer makes the contributions, they're deductible and they're not subject to employment taxes. And I just have I have a link for you to see what the applicable rules are for 2023. Okay, next. Here are some other arrangements. There's a qualified small employer health reimbursement arrangement at QSARA. There's a limit that the government sets on what you can pay each year toward employee self-obtained coverage. With the individual coverage health reimbursement arrangement, it's up to the company what you want to reimburse. There are cafeteria plans where you can arrange to have employees pay their own coverage on a pre-tax basis, and then you can offer other plans where employees can pay for other additional things out of pocket on a pre-tax basis. Next. There's a Paid Family and Medical Leave Act if your state doesn't require you to do it. Florida does not require employers to offer paid family and medical leave. So if you want to pay for it, you may qualify for a credit. Another credit is disabled access credit to make your premises accessible. Next. All right, let's talk a little bit about your customers and what's new for 2023 and what you should be thinking about and how it kind of relates to taxes. These aren't direct impact on taxes, but obviously how you deal with your customers determines your revenue, which in turn determines your taxes, obviously, how much money you make. So, think about your payment methods and your delivery. And a lot of us are contending with supply chain issues and, shipping it's more costly now than it has been in the past. When the postal rates went up, FedEx and UPS follow suit. So it's going to cost more to ship. So decide whether offering free shipping is something that you can afford to do. Remember, if you're paying for it, you get to deduct it. So that's something. Next. This is something that's so important, and I can't emphasize enough that you have to say if you have to invoice, and many businesses still have to invoice, you can't collect on the spot. Don't let receivables age, because the longer they become uncollected, the less likely it is you're going to get some or all of your money. And if you are on the cash basis, which most small businesses are, meaning you're not an accrual basis taxpayer, you're a cash basis taxpayer. When money comes in, it's income to you. When you pay an expense, it's deductible by you. That's cash basis. And if you don't collect your accounts receivable, you can't write them off. So you want to stay on top of that. If you pay a collection service or an attorney to collect your outstanding receivables, you can deduct your costs. Payments in cryptocurrency. More businesses, even small businesses, are moving toward that. Understand how that works for tax purposes. It's not currency, even though the word currency is contained in the word there. The IRS looks at it as property. So when you get paid in cryptocurrency, you have a gain or loss depending on the value of the currency when you get paid. And it's quite complex. Reporting rules are going to be changing there. So they're applicable to 2023 payments. So we're going to see this. We're going to get information returns and all kinds of rules for 2024. We don't have a whole lot of clarity on this yet, so I don't want to spend too much time on it, but just a heads up, cryptocurrency isn't currency, it's property. Next. Review your pricing and factor in various changes, as I mentioned, for your shipping costs, for what you're paying at the pump, what you're paying in taxes. All of these things impact your pricing. Next. All right, businesses. Almost every business or business owner has a vehicle. Should you buy or lease? And what can you write off? There are two ways to handle your business driving expenses. Whether you buy or lease, you can use the IRS standard mileage rate, which has increased for 2023 to 65.5 cents a mile. Last year, you may recall that we had two mileage rates because of the pop up in the price of gas at the pump mid-year. So that's kind of unusual. It's only happened a few times, but something to watch out for. Should you buy an EV car? Why am I talking about this? Because the Inflation Reduction Act, which passed last August, really, think of it as a Green New Deal, because there were so many tax incentives for buying EVs and related equipment. So we have this year what's called a commercial clean vehicle credit. And again, the credit depends on how the vehicle's powered, entirely EV or not, whether the weight of the vehicle. If you are a business owner and you use your personal vehicle for business driving, then you're subject to a consumer credit, and it's a clean vehicle credit, and there are income limits and limits on the cost of the vehicle for determining eligibility, and the vehicle has to meet a final assembly requirement, meaning the final assembly occurs in North America, and you're going to have to report things on your tax return for all of these EV related credits. I just want to point out that the cost of insuring an electric vehicle, it's more than a fossil fuel vehicle. So that's a business consideration and something to take into account. Putting in a charging, just one more thing, putting in a charging station, you can write off the cost, but only if you're located in a low income or rural area. So you're going to need a charging station, but whether you get this special credit for it will depend on where you're located. Okay, next. Thanks. Okay. It's always a question for business. Do you repair, replace, or or just add new equipment and machinery? You want to be as efficient as possible, and there are various ways to write off the equipment. Next slide. Next slide, please. One of the ways is to just expense it, meaning write it off in full. You have to elect this. It's a considerable write-off allowance and applies to certain property. The point I want to make here is that it applies whether you finance the purchase in whole or in part. So financing doesn't impact this tax write-off, which is great to know, because it really can help you with cash flow if you're financing it and you're still getting a big write-off. But you only can use this break if you're profitable. So if this is not a good year for you, this isn't the year to elect this option. Next. We have another is bonus depreciation, but it's been 100% for a couple of years, but starting this year, it's only 80%. So, and it's going to phase down. So this is an option that applies automatically, but you can opt out for it. And why would you want to opt out? Next slide. Because you can use regular depreciation, which is a write-off that you claim over a fixed number of years. The law determines those number of years. And maybe if you're going to be more profitable in the future, then that deduction is worth more to you in the future. There's also an option to not do these kinds of depreciation related write-offs, but instead treat the item as a supply, in effect. It doesn't go on your balance sheet. It's not considered an asset, and you're allowed to deduct up to $2,500 per item or invoice, and you have to file a certain election with your return and such. But it's a really good option, and certainly, like if you're buying a tablet, why keep records and do all this? And this is a good option to minimize your administration and your record keeping. Next. All right, new deduction for energy efficient commercial buildings. This is for getting them energy efficient. This is a higher deduction amount for 2023 than it was allowed previously. There are tax credits for adding solar or alternative energy sources. Somebody I know who he owns a small strip mall, and he put solar on the roof and got a good tax break for it. Next. Builders, if you're putting up energy efficient homes, whether single family, multifamily, or manufactured, new credit rules apply this year, and they're really pretty generous compared to what was allowed in the past. New standards, though, and so I'm not going to, obviously can't go through all the standards of the energy that requirements that you have to meet in terms of eligibility. And they're also wage and apprenticeship requirements. You have to pay prevailing wage and offer apprenticeship if you have 4 or more employees. So I think what this kind of boils down to is that the tax rules are really complicated. They get more complicated every year. I've been doing this for nearly 50 years. And I can tell you that, this is not really a DIY activity, that you really do need a good CPA or other tax professional to determine how things apply to your situation. I'm an advocate for having people understand what the tax rules are, because it's up to you as the business owner to make business decisions. I mean, the buck stops with you, right, for your business, and to be able to ask good questions of your tax advisor, but don't make the final determination without running it by a professional. Next. Research and development, new rule that you have to, in the past, you were able to write off the costs or take the credit. Now you have to amortize them, meaning spread the costs ratably over not less than 5 years, and you have to file for a change in accounting period if you used to do the immediate write-off. Again, complicated. Next. You probably know by now, if you got a PPP loan and it's forgiven, the loan is not taxable to you. It does count as gross receipts. It does impact certain tax eligibility rules, but it's not income. But if there's any misrepresentation or omissions in the paperwork that you filed, the IRS says it is taxable. And last August, they passed 2 laws giving the government more time to find fraud in PPP loans and the SBA EIDL loans. So just be aware that the government has lots of time to find you if you've been naughty. And none of you have been, I'm sure. I'm just putting it out there. Next. Travel expenses. Well, a lot of people travel. Well, yeah, one of the ways you can write off the actual cost of travel, or you can rely on certain per diem rates that just take care of you don't have to keep the receipts for everything you spend. There's an IRS rate, and then the General Services Administration has rates too, and the links are there if you want to check them out. What is new for 2023 is that we're back to a 50% limit on meal deductions. So for 2021 and 2022, you could write off 100%. Well, now we're back to the old 50% limit. And this applies even if you're using the per diem rates. So you still have to factor in the 50% limit. And I have to tell you, this is where an awful lot of mistakes happen, that and the IRS catches this. This is one of the places they look at, because they know that that businesses forget to apply the 50% limit. So you don't want to do this. You don't want to attract any attention to your return. Next. Accounting method. I mentioned before, cash method or accrual method, but also whether you have to account for inventory or just treat it as non-incidental materials and supplies. Decide what you're going to do with inventory that becomes slow moving and you can't get rid of. And there are a lot of options, and they have tax consequences depending on how you treat them, whether you destroy it or donate it or put it, have fire sales or whatever. All of the decisions that you make to get rid of inventory that you can't sell normally will have tax consequences. Next. Okay, interest expense. If you incur a business loan, you think, well, the interest is tax deductible. And if you're a small business, yeah, it probably is. But if you're not a small business, then there is a limitation. And I don't want to, go through all of this, but just you have to determine whether or not you qualify for this automatic small business exception. And it's the gross receipts test that I referenced on a previous slide. And that determines whether you are automatically able to deduct all of your business interest. Next. businesses are amazingly charitable, whether it's to local causes or participating in what's going on in your community. There are limitations, and I just want to point out that the limitations that had applied previously during COVID, we have old limitations, pre-COVID limitations on what you can deduct. You also need, if you're donating property, you may need to get appraisals, qualified appraisals, and you must have substantiation. A written acknowledgement from the charity for any donation, cash or property of $250 or more. Again, these are things, you just keep this paperwork with you. You don't file it with your return. But if the IRS asks for it and you don't have it, you lose out. And I can't tell you how many cases of what I would consider big companies have failed to do this. So don't you do this. Get those before you file. As you're getting your paperwork ready for 2022, just run through it and make sure you have any required substantiation for donations you made last year. Okay, next. Okay, if you are an owner of a pass-through entity is a sole proprietorship, a partnership, a limited liability company, an S corporation, which almost every small business is. If you have losses in excess for the year in excess of a certain amount, you can't just deduct them on your return. You can't just use them to offset other income that you may have. There's a limitation, and the limitation I've listed in your slides. So that's kind of bad news if you happen to have a bad year. But the good news is you don't lose the losses. They just become part of your net operating loss, which is on the next screen. And net operating losses are losses in excess of what you're allowed to take every year. We no longer, during COVID, we had carrybacks, meaning that if you had a loss for the year, you could carry it back to offset income in a prior year and get a refund. Well, we don't have that anymore. What we have now is you have a carry forward. So any losses that you can't use currently get carried forward and can offset taxable income in a future year. Only an 80% offset, so you may be carrying it forward and forward and forward and forward, but you can, it's indefinite. You can keep carrying it forward till you use it up. The point that you need to know is because these NOLs go on forever for some businesses, you need good records. And just because the IRS didn't question a carry forward in 1 year doesn't mean they're not going to question it in another year. And the tax court has made it very plain that each year stands on its own. So just because they didn't question it in a prior year doesn't mean that they can't do it in a different year. And it's up to you to prove how you figured your net operating loss and what losses you claimed year after year. Next. One of the really good breaks for owners of pass-through entities is called the Qualified Business Income Deduction, the QBI deduction. And what this is kind of like a bonus. You don't have to have any expenditure in order to claim it. You get it if you're entitled to it. And it's actually a personal deduction. You claim it on your 1040. It's a personal deduction just based on your business income. So, you know, there are computations involved here, and I'm not going to run through them. But the good news is, like I said, it's up. Let's go to the next slide. It's up to 20% of your qualified business income, as long as your taxable income is not more than the numbers I have on your slide for 2023. And the taxable income threshold is higher in 2023 than it was in 2022. So it's great. You're just getting this extra deduction. It came, just so you know, it came into effect back in the Tax Cuts and Jobs Act of 2017, when they slashed the corporate rate down to 21%. And they wanted to figure out, well, how can we help pass-through owners because we didn't cut the individual tax rates. So this was sort of the way they did it. Is it the same? Does it equate? I don't think so, but it is certainly something. And as I said, since most small business owners are pass through, then this is certainly an important break. Next page. If you, next slide rather. Okay, so if your taxable income exceeds the threshold that was on the prior page, the computations become rather onerous and hard to explain. So I'm not going to explain it. I'm just laying it out for you here on the slides. It's obviously something that you need to discuss with your tax professional. And of course, if you happen to do your own taxes using software, all of this is, you just put in the information and you don't make the computations, the software does it for you. So that's certainly a big break there. Okay, next slide. Okay, let me just give you some of my final thoughts, and then we'll jump into questions. And I hope you have a lot of questions for me. So it's a great time to meet with your tax advisor now. Even though they're focused on 2022 returns, it's not too early to start thinking about your 2023 taxes and what they have to say about it, what their suggestions are. And again, it will help you determine your first estimated tax payment for the year. And it's my experience that most small business owners do pay estimated tax. You don't need to if you are an S corporation owner, because you get salary and you can have your withholding cover your estimated tax projections. But other than that, you even S corporation owners may have the supplemental estimated tax to cover their share of tax, the tax on their share of profits. So another thing is to watch for developments from Congress and the IRS. We are anticipating many sets of guidance from the IRS on new rules that took effect in 2023. We have very little guidance. We have some guidance so far, but there's going to be a lot more that will clarify the rules. We're waiting for rules more on cryptocurrency, and Congress is still Congress. They're still talking about tax changes, whether that is, you know, whether it's going to be favorable or unfavorable. Who knows? The fact that we have kind of a divided Congress means that it's kind of unlikely we're going to have something really dramatic this year, but you never know. You never know what happens in the world that may be an impetus for Congress to make some tax changes. So with that, I'd love to take your questions.
All right. Thank you, Barbara. My head is spinning.
Oh, I hope it doesn't spin. I just want to mention two things before I leave. If we don't get to your questions, feel free to send them to me. I will try to answer them. I can't give you tax advice, but I can perhaps give you some information or point you in the right direction. Also, everyone who's attending today, I'm going to be sending out invitations to invite you to join my mailing list to get my idea of the day, which is a 2-sentence freebie that comes out in the morning to alert you to things that are happening that you should know about. And perhaps not everything is applicable to you, but hopefully a lot are. And I have gotten favorable feedback on that over the years, and I think it's something, but again, it's just an invitation and you can sample it and unsubscribe if it doesn't help you. Okay, let's turn to the questions.
Wonderful. So before we get there, I just want to reiterate score.org/Minnesota to request a mentor. We as mentors can't help you with this tax advice either. That you really have to pay for a professional. I think that was probably one of the best pieces of information, most important pieces of information that Barbara had. You can look for other workshops or search for other items that we have on our website. Also, one last thing before we get to questions, you will be getting a survey. And it would be great if you could take a moment to fill in the survey. The first thing is that you'll be rating Barbara on a scale from 1 to 10, 10 being the highest. And we think that probably she's worth an 11, but that's not possible. So
Thank you.
10s would be great if you could do that. And also part of that survey is a question: what other topics are you interested in? As I said, I'm the education chair. I was just assembling those yesterday from October, from all of the first part of the year. And you all have some interesting ideas, some of which we have implemented and some that I'm absolutely now thinking of. So if you get that, when you get that, if you could fill it in. Now we're up to questions. So Jennifer said, if you don't have any employees, if it's just a husband and wife and an LLC, do these things apply?
Well, a lot of the things apply. What would not apply is the credit for starting a retirement plan, because that credit requires that the plan cover at least one employee who is not an owner or highly compensated. So that particular credit would not apply, but many of the other things that I've discussed do apply. For the qualified business income deduction and such. So you have to look at the specifics of each particular tax break. And I tried to emphasize today the things that are important or new or changed for 2023. But gosh, there's so many breaks out there. You know, I didn't talk about home office deduction and many other tax breaks that small business owners would be using. So you want to go through everything and see what would apply for your situation.
So Andre is asking, thanks for the important information shared. Are any of the healthcare options you showed available for companies with only 2 employees?
Yeah, you know, here's an interesting thing. If you are could be a sole proprietor, any kind of organization, and you put your spouse on the payroll, your spouse becomes an employee and you can get your coverage tax-free by providing your spouse with coverage for your spouse's spouse. In other words, for you. So that's a way to transform your coverage into 100% deductible. Now, if you're self-employed and you pay for your health coverage, it's a personal deduction on your return. It's 100%, but it doesn't reduce your business income. It doesn't reduce your self-employment tax. There is a law that's almost every year, including this year, is pending to transform that into a business deduction, because employers get to deduct the coverage for employees. So we'll have to see. But right now, you know, there are certainly ways, even if you're just by yourself, to make coverage tax advantaged.
Anonymous is asking, the meal expenses, how is it posted since the receipt has the full amount? How do you break it up in QuickBooks?
Well, it's easy, because in QuickBooks, you just enter the whole thing. And on the tax return, and the software will do it, or your professional will do it, there's one line where you put the 100%, and then there's the second line is 50%. So you just do the 100%. You don't break it up in QuickBooks.
Good. So another anonymous, the impact of losses. I invoice customers, and sometimes they only pay a portion of the invoice or bill. How can I record the difference as a loss? How does it get posted in QuickBooks?
Well, I'm not a QuickBooks expert, because I even have someone do QuickBooks for me.
Sure.
But I will just tell you from a tax perspective, I know that you can record partial payment, because I have done that, where I've gotten partial payment. A customer has only paid part, and then you can record the rest. So I think if you just look at the screen, it pretty much tells you, you enter what you've received, and I think that kind of is how
Right.
it works.
I think it then carries it over.
Yeah, exactly.
Mhm.
And then
Yeah.
it's still an open receivable that hasn't been fully paid.
Right. So Danny is saying he hasn't completed his LLC yet. Should he wait to do so before purchasing a used truck for his painting business, or should I make the purchase from a business account, or can I purchase from my personal sources?
You know, that's a perennial question. Should you own the vehicle? Should the business own the vehicle? And there are pros and cons to that decision. So, for example, if the business owns the vehicle and it's in an accident, only the business is responsible. You don't have any personal exposure because it's the business vehicle. Insurance is usually higher if the business owns the vehicle versus if you own the vehicle. If you own the vehicle and drive it for business, you get to write off the costs allocable to the business use. So, you know, you have to maybe work this out with a tax pro and put pencil to paper and decide which is the better option for your situation.
All right. This might be the last question from Hassan. Are credit card payment statements considered proof of transaction, payment, and expenses?
Okay, that's a really good question, because in a lot of cases it is. So if you're buying, you know, you go to Staples and you buy a ream of paper and you charge it to your credit card, that's proof that you bought that supply. But when it comes to certain costs like travel and meals or your vehicle, the tax law requires special substantiation. For example, with travel, it's not just enough to have the hotel receipt. You have to have records in addition to that saying, you know, where you traveled, what were the dates of the travel, why did you go there, what did you do? And so you really need to look at the special substantiation requirements. And I draw your attention to IRS publication 463, which towards the end of it, and it's just on the IRS website, 463, and it has a list of the special substantiation rules that you need for your car, for your meals, for your vehicles, for business gifts and such. So it depends, again, whether the credit card is sufficient. I don't know. You know, in the past, in years past, now everything's electronic, and they send you things just electronically. But in the past, the American Express, when they used to, do you remember the machine that they used to swipe across the
Oh,
old
yes.
card?
Mhm.
Well, that receipt used to have had space on it to enter all that information manually, that you could enter who you were having dinner with, what you were talking about and such. So
That's a few years ago, Barbara.
yeah, well, yeah. Yeah, well, I've been around a few years, so
It's funny when the power goes off or the internet goes off, and now they have to give you a receipt, and their machines are not working. I remember sometimes they would dust off that machine and run it through.
exactly.
I don't think it works anymore because the numbers are not elevated on the cards.
Yeah, you're right.
Angel is asking, can you please clarify the S Corp tax if you get a paycheck / payroll?
Okay, well, if you are an this is an important point, because I think this is confusing to a lot of people who are just starting out. So if you are an S corporation, if you have an S corporation and you work for your business, you're an employee, and you can take a paycheck just like any other employee, whether or not they have any ownership in the business. So you can have withholding, you have the same payroll taxes as you would for any employee. If you are a sole proprietor, a member in a limited liability company, or a partner, you are not an employee and you cannot take a salary. So you can take a draw, you can take money out on a regular basis, but there's no withholding on it. And it's up to you to pay estimated taxes unless you have another way to pay your taxes. I mean, if you have a job in addition to your business, you can have withholding on your paycheck from the job to cover it. If you have a spouse who works and your spouse is willing to increase withholding to cover the tax on your profits, that's another way to avoid estimated tax. But otherwise, if you are not an employee, you're self-employed, you have to pay estimated tax and you can't have withholding.
Oh, I was just going to say that was the last one. 2 questions popped up. Follow up from Angel. So does this cover the business taxes that are due by April?
Okay, so you can adjust your withholding on your salary from an S corporation so that it is sufficient to cover your tax on the profits from the business. So it's up to you, though, to do it. It wouldn't be like just, the regular way to figure withholding based on your ordinary W-4. So you can increase your withholding, but it's up to you to do it.
And Tracy is asking, when should you change from LLC to S Corp? We started our business last March. Can you change mid-year?
Okay, you can change, yes. If you change, first of all, let me just explain. If you're an LLC, you can elect to be taxed as a corporation and then make an S election. And what this does is allows you to take a salary and such, but the S election has to be done in the first 75 days of the year. If you miss that, then you have to wait till the next year. So, basically March 15th is the deadline for the current year. So if you wanted to do it for 2023, it's too late for 2022, but if you wanted to do it for 2023, you better do it by March 15th and talk to a tax advisor to see if this is the right thing for you.
Well, you are a font of knowledge, Barbara. They didn't trip you up with any of their questions. I think it's your 50 years of experience that you can pull it out, answer out. One more from Angel. If I increase it, I don't have to send additional taxes. So if I understand, I am paying the business tax along with the taxes.
Yeah, okay, so an S corporation obviously doesn't pay tax, it's a pass-through, but you as the owner pay tax on your share of the profits. So if you increase your withholding on your salary, it can be sufficient to cover the tax on your share of the profits.
Good. Got it, said Angel. Okay, good. Wonderful. That is it. Time has run out. It is 12:59. You are a true professional. Gave you an hour. You took an hour. And I want to thank you so much for sharing your knowledge. Everyone is saying on the chat how fabulous you are. Great presentation, wealth of knowledge. Thank you so much. They all love and appreciate you. You might all remember you will be getting a copy of the webinar slides and the recording. And so Barbara's address will be on there. So you can contact her and it will be worthwhile, I think, getting her daily hints because Congress is moving, not fast, but they move and they change and they make life more complicated all the time. So keep up with it. Wonderful. Well, thank you, Barbara. Again, I can't thank you enough for sharing your knowledge and expertise with our group. You were fabulous. I hope we get to see you again, if not next year, when you're saying what they should be doing to prepare for 2024.
Okay, sounds good.
All right. Thank you all. Bye.
Bye-bye.